This is the current federal tax developments for the week of September the 29th, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, and this week we're looking at developments that have taken place here right toward the end of September. Just as we're facing a potential government shutdown this week, may or may not be resolved by the time you listen to this. All I know is what I have right now, which is no resolution in sight, but we'll see what happens. There's still some time because I'm recording this on Saturday. This week we have a few decisions and a few other case issues to look at. First, going to talk about a case that came down from the tax court dealing with the hobby loss rules. This is the case of Young versus Commissioner. We're also going to talk about the IRS Notice 2025-52 that deals with drought-forced livestock sales, and just indirectly discovered that apparently there's at least one county in each of 49 of the states, plus I believe the District of Columbia, that is in a drought condition. And we'll discover that when we get there. The IRS updated the special per diem rates. We saw that in Notice 2025-54. We also got the official news release this week that talks about the end of paper refunds, apparently as of September 30. So we'll talk about that. It is IRS News Release 2025-94 and the implementation of something we've talked about earlier, Executive Order 14247. We have another syndicated conservation easement case, Jackson Stone South LLC versus Commissioner. This one is really probably unique only in the amount of overstatement of the value that was involved or found by the court. It was somewhat substantial, shall we say. We're going to talk about a case of someone who, first thing is, if you're trying to challenge, let's say, a claim of a fraud penalty, it's best not to have been convicted prior to that. That's something that's pretty clear, and we've seen this a few times. But this one deals with exempt organizations also, and embezzlement issues. So we'll take a look at that, or effective embezzlement. There are some unique issues. The DC Circuit overturned basically a decision of the tax court about awarding a payment to a whistleblower. So in a whistleblower award, so this is in resealed case number 241001. And it's interesting because the DC Circuit found there was no rational reason why, because this particular person submitted a number of whistleblower claims, had uncovered an issue, and they didn't understand why, for all but one, he was paid the max award, and how come the last one was a different payout. And the DC Circuit just had trouble understanding that, and so they overturned that. And finally, we have a person, now this is kind of the opposite of what we often think of as the issue, but this is a case of a taxpayer who did not want to be treated as an employee for tax purposes. And so the case of Gill versus United States from a district court for the Eastern District of Pennsylvania, we will talk about his attempt to say, hey, I'm not really an employee of Wells Fargo. Rather, I'm an independent contractor. And we'll talk about whether he succeeded in that position. But let's start with the 183, the hobby loss rule case. This is a case of Young versus Commissioner, Tax Court Memorandum Decision 2025-95. This case came down on September the 25th, 2025. Now, Section 183 is a section that denies any deductions to a taxpayer for amounts, or not any, well, effectively any now, but denies, in essence, losses to a taxpayer for any activity that was not engaged in for a profit. It's the 183 hobby loss rules. Technically, as we've discussed previously in an earlier case, if it is found that you have violated the 183 rules, or you basically your activity is not truly a trade or business, those deductions become 212 deductions. And post Tax Cuts and Jobs Act, and now post the One Big Beautiful Bill Act, those deductions are effectively non-deductible. So it can be a very bad result, especially if there's significant income, but nevertheless still a loss in the activity. Well, this involves a case of a taxpayer's Peca de Rosa Ranch. Not sure that's the right pronunciation, but we'll go with it. Whether that was an activity engaged in for profit to allow them to deduct substantial losses. That's normally the issue we're at here, right? Now, there are some key facts here, and these facts tend to be significant. One key one, which really is important, is that the taxpayers had significant income from other sources. They had wages of over $2.9 million and S corporation pass-through of over $16 million. Now, in this case, it was a married couple. The wife had most of that income, and she was the one who was basically had the S corporation interest and had most of the salary. But the activity involved her husband, so we'll get into that. Now, this ranch produced very consistent large losses over many years. It had $3 million over the total time they'd had it, but for the years before the court, it had lost $257,000 and $305,000 in the 2 years before the court. Now, Mr. Young, the husband, had extensive ranching experience. His wife, Ms. Young, had a strong business background. So she knew a lot about business, and she's well compensated, involved with those issues. Now, interesting enough, though, despite her background, the business practices were very, very informal. They commingled personal and business funds. They had no general ledger, and they didn't produce a business plan until after the audit began. In essence, they finally kind of cleaned up the operation of the business only after the IRS showed up on the doorstep and did those issues. And there was a very significant personal pleasure element. Mr. Young was a longtime competitive team roper, and this was a pecan ranch. Effectively, when, initially, Ms. Young had owned it with her deceased former spouse. They had owned it. They had their home there. And when she later married Mr. Young, they went ahead and they built this really, really large arena on the property because he was a competitive team roper. Now, you don't rope pecan trees, so we have to realize that, that's kind of a little different what we're looking at here. But that was a large personal pleasure element. He did have background, Mr. Young did, in dealing with the pecans, as I recall. But that's, where a lot of the losses and expenses are rising from is this giant arena and the competitive team roper issue, right? Now, the first thing the court had to do was define the activity. So it looked at Treasury Regulation 1.183-1D1. And that talked about, when can you consider the holding of land which could appreciate to be part of the operation of the farm, the ranch, or whether they were two separate activities, right? Now, in this case, he said, no, that we have to break that into two pieces because there was a very significant non-business reason for having this land. And reality was it predated, well predated what they did. So it said the property's significant function as a personal residence for a long time, right? And it was the same land that they had before, weighed against integrating the land holding with the ranching operations. It was their personal residence. They had built this arena. It was a nice big area that they had for their personal residence, but they built it on their personal residence. Kind of, let's just call this their lawn, right? They had built this there, and the court ruled that, well, the land was being held because it was someplace, Ms. Young had lived for years, and, it was home. So that was a key issue. Now, that is a problem because now suddenly, having lost a couple $1 million, you can't say, but look, we did that, but we're really planning to make the money off selling the property. Eventually, the appreciation of the property would cover that. Because again, you could demonstrate that economic increase in value, but again, under the tax law, until it's sold and realized, it's not going to show up on the tax return. The court said, nope. Now the farming, ranching, the ranching and the pecan farming activities, they're actually one activity. They have to stand alone, and those of what have been generating the big losses. So the court then applied the 9 factors from Treasury Regulation 1.1832 subsection B to the standalone ranching activity. And what they did, they applied the 9 factors. They found 6 of them favored the IRS, Two of them favored the taxpayers, and one of them, or one favored the taxpayer, and two were kind of neutral. Didn't really favor either side. Now, factors favoring the IRS, and I am going to stop on the ones that really are the important ones in these cases. We'll do it. Manner of operation, not businesslike. They commingled funds. They had no plan. Again, not really, a major thing. I've seen things clear without that being a problem, even though they were very informal. Asset appreciation. They were not expecting ranch assets, excluding land, would recoup the huge losses. Again, an issue, but that's probably not by itself the serious issue. A long history of losses. That's usually why the service shows up. That's why you get the notice of exam. There have been losses year after year after year after year. That long history, unbroken history of substantial losses is a big red flag. That's red flag number one, but it's not by itself enough. There's one other issue, like a couple of other issues that matter here, okay? Occasional profit, it had never generated a profit. I never thought that particular, reason, I guess it's listed separately in the regs because in theory, well, maybe just to say, hey, if they've generated a profit, like, they lose money 4 out of 5 years, but every 5th year they make money, and that maybe that's an indication that it might be able to turn around. It's there. We're not going to worry about it. Next one is huge, financial status. Their high income from other sources enabled them to sustain the losses and gain a benefit from the tax deductions. In essence, they could afford this. That's a really, really big issue. Here's the catch. If they were literally going bankrupt by doing this, if they literally, were about to lose the home, right, because their cash flow is gone, they don't have any money. If that's true, even though you've had substantial losses, right, the idea is, well, yeah, you're crazy, but apparently you think you can make money doing this. You can't, by the way, but maybe you literally thought so. But again, that's not what's showing up here. Financially, they can afford to take it, and that's what makes the last one then crucial. Is there personal pleasure? Is there a strong recreational element? Do you enjoy it? And the team roping here was a big issue, right? It was something he had always done for a hobby. So yeah, kind of saying that true, just literally. So, they're trying to convert that into some deductions, building this huge arena and doing those other issues were mainly, just to make it easier for him to do the thing he enjoyed, is the way the court looked at it. Therefore, this was not being conducted as a trade or business. Now, the factor that favored the taxpayers was they did put substantial time and effort into the ranch, which is good, but it's really offset by the personal pleasure. That's kind of the big problem, is in essence, if you really like doing something, maybe you're a hiker and you go out and you hike a lot, you'll spend a lot of time and effort hiking, but that's not going to make you money normally. So that's kind of how this goes. And then neutral factors, their expertise in the area. Yeah, he knew it and she knew business, but she really didn't use her business area much. And, and it was team roping and he hadn't really run anything. So, yeah, but he knew it, but didn't. And success in similar activities, well, they'd never really done anything similarly. So they weren't either successful or failures. So they said those are neutral. So on paper, the way the court will read this is 6 are in favor, 1 is neutral, 2 are against. But as I said, primarily the big problem was they could afford the losses. They had big losses. And what he was doing was something he enjoyed doing. Those tend to be fatal to these issues. And in this case, it was. The Youngs did not have an actual and honest proffer motive. Therefore, their losses claimed on Schedule F were disallowed. They also upheld the accuracy-related penalty for the 20%. They said the taxpayers could not rely on their account to avoid penalties. The court noted, if all you can show is you hired this person to prepare a return, that's not enough to show you had advice from a professional to enable a reasonable cause defense under 6664C? Did you specifically inquire of that person about advice on whether or not, you could claim these deductions, what you should be doing? Did you actually get advice, and did you follow that advice? There's no evidence here they did. They simply did it. Obviously, key things we have here: documentation is useful, business plans, separate books and records, and an effort to improve profitability before the audit's crucial. But all of that, even to be honest, is not great. It's not going to really save you. If it's pretty clear that, hey, I don't buy you're trying to make a profit because you've been operating at a loss for a long period of time, you can afford to absorb the loss, and you like doing it. That triumvirate tends to be fatal, and that means you couldn't really recover, I don't believe in this case, simply had they documented things better. Yeah, bad documentation is not great, and really, you want to try to help it. And of course, the court kind of phrases it as if things like that were key. But only if that documentation reasonably, when you look objectively at the fact, how this thing's been running, only does that really make sense. If you had everything documented, you had made significant changes every year that makes sense, that you would think they might have improved things and made it profitable, and they just kept failing. Well, after a while, we begin worrying. The problem is, the more times you fail at it, the more likely it is they're going to conclude that you should have figured out by now you don't know what you're doing. In any event, that's the problem. But there is a key issue to consider here, right? The regulations that the court relied upon are right now under question in another tax court case. In last May, the tax court issued a decision in the case of Schwartz versus Commissioner, which was essentially, slightly different facts, but basically the same problems, right? We looked at, what was the activity, there was the land separation issue, and as well as using the 9 factors. And so because of this, right, that decision was issued in May. You may remember, in June of 24, the Supreme Court came down with the Loper-Bright decision. Now, Loper-Bright says that regulations are not automatically given deference. Previously, before Loper-Bright, a regulation would be accepted as valid if the regulation was reasonable interpretation of an ambiguity in the law, even if there might be, in the court's view, a better way that they could have approached resolving the ambiguity. Loper-Bright, therefore, says that, Chevron deference, which was the old rule, no longer applies. The tax court accepted when Schwartz asked for reconsideration that, yes, the court had relied upon Chevron in accepting that the regs are how it should test it, and they had relied upon the regs. And note, this decision we just got in the Young case clearly also relied upon these same regs and these same issues. Well, the court agreed last November to reopen, basically reconsider the decision. And now there have been a whole bunch of, filings piling up, arguments in place about why why the regs are or aren't valid. And if they're not valid, then, what tests should be done. And then we get back to how to apply this, but all of that. Now, these regulations have been criticized before, even, before Loper-Bright. In fact, in a rather funny case, I thought, from years ago in the Seventh Circuit, the case of Roberts v. Commissioner, which was decided on April 15th of 2016, great date for a tax case to come down. Judge Posner, who tended to write decisions that were, shall we say, that would have an edge to them. He was entertaining to read. I don't think he and Scalia saw things the same way in a lot of areas, but they both wrote very similar scathing opinions in many ways. Well, this was one of the last classic Posner decisions before he retired. And he called the regulations goofy, the 9-factor test goofy. And specifically, kind of decided around it and reversed the tax court in Roberts and found there was a profit motive. Now, he didn't say the regs were invalid. He didn't go beyond that point to say they were invalid because they weren't really raising that directly. He just called them goofy. Well, calling regulations goofy is hardly an endorsement that they are the best analysis one could have. So bottom line, I've always thought that these regs have the best shot, at least right off of ones I could think of being reversed post Loper Bright, or at least being, well, they're not really very useful. So, no, we're just going to go with the law's general outline and try to figure out, is there evidence you had, that you had the requisite profit motive? And these factors would still kind of come into play because you got to make a decision somehow. But whether these 9 are somehow more important than anything else is a different question. In fact, the funny part is Posner in the decision was noting that, in fact, the regs themselves even suggest that other factors could be important, in which case he says then they're not really saying anything. Okay. And even if they decide those regs are invalid, the courts would still have to apply some sort of standard. So it's not as if that would happen, it got turned over. I will note that it appears at least nothing in the decision indicates that the question of validity of these regs was directly addressed, or at least was taken care of earlier. And obviously the court, either found they were valid, or the taxpayer never raised the validity question. In which case, then the court's not going to deal with a question that wasn't put before it. So we'll see. But keep your eyes on, as far as hobby loss rules, we do want to see what the tax court does in the Schwartz decision. Is it issued? Now, we'll see if it gets revised or not, because sometimes, the service may decide they'd prefer not to have a negative decision come out. So you might see them settle with Schwartz and remove this from the table. We don't know. We just have to see what's going on. But there have been filings recently, so I don't think it's dead yet. So I think we may see something. Next up, the IRS has extended drought relief for another year. This is IRS Notice 2025-52 for September 22nd, 2025. And I should say extended drought relief for another year for certain affected counties, but it seems like they're basically the whole U.S. Well, except for one state. Certainly in Arizona, I think every county was on the list. So I'll go from that standpoint, which I guess for drought kind of makes sense, but it's not necessarily for northern Arizona. Of course, down here in Phoenix, although yesterday, what wasn't a day we would say that looked like drought time. We set some records yesterday for droughts, for rain coming down quickly. It was kind of funny, watching everything come apart. You found out if your roof leaked yesterday for sure. Various odd things. I saw a picture from a friend of mine who's a teacher, and they have this area between the buildings, and it's just it looks like a pool because the water was just pouring off the building so quickly and building up. And because of the clay soil here, it's very easy for the ground to get saturated. And so it's just kind of like this pool between buildings, just a giant pool. I mean, literal pool between buildings. So yeah, it's kind of interesting. It didn't get up and enter the building, so I guess that was good news. But we had that yesterday. So this notice, though, getting back to that, provides an automatic extension of the replacement period under 1033E for farmers that were forced to sell livestock due to drought. Now, either you're in this area or you're not. If you're not in this area, you probably have never heard of this. If you're in this area, you've heard of it quite a bit. You work with clients in this area. Now, under 1033A, 1033 is, where you basically, if you have a casualty gain, you can, basically, and you incur that. If you reinvest the proceeds within a certain period of time, you can defer recognizing that gain. Section 1033E treats the sales of livestock held for draft, breeding, or dairy purposes in excess of normal business practices and involuntary conversion, what 1033 covers, if it is made solely due to a weather-related condition. So this would allow for deferral of gain if the livestock is replaced in a specified period. And the reason why we have this special rule under 1033 is because instead of we can get a longer period of time. That replacement period is extended to 4 years if the area was eligible for federal assistance based upon those weather conditions. And the IRS has the authority to grant further extensions of time if the drought conditions persist. So you have up to 4 years, but you can get more time if the conditions persist. So if we get to the 4th year and we're still in a drought situation, then they can say, well, drought still exists, so we're going to extend the period, right? So notice 2682 is the procedural background that talks about how the IRS deals with this situation and extending it. These are the rules for the automatic extension. And the replacement period is extended until the end of the taxpayer's first year that concludes after the first drought-free year of the region. So the idea is 4 years is automatic. But then we look at if the fourth year we're still in a drought period, then we keep going on until we get to the year that ends after the first drought-free year for the period. Now, there's a weird rule here about that. A drought-free year is a 12-month period ending August 31st. It has no week with exceptional, extreme, or severe drought reported in the applicable region. Right? And this applicable region is the county where the droughts occurred, plus all counties that border that county. So each September, the IRS publishes a list of counties that experienced qualifying drought levels during the prior 12 months. Notice 2025-52 is the list for this year. So if you're dealing with this, right, you've got clients with livestock who have been forced to sell part of the herd because of the extreme drought, then you pay attention to this notice, right? Now, this notice list, this is a big list. It lists counties across 49 states that experienced a qualifying drought level for the 12 months ended August 31st, 2025. Now, those of you from most of the country, if you looked at Arizona, you think, well, that's not that many counties. Hint, Arizona has big, geographically big counties. We don't have a whole lot of counties. I think that's 16 now. Anyway, so that's why Arizona's list looks short, but it's not really. It's pretty much a whole state, right? This is the issue. And again, 49 states. So I didn't check to see who was the one state that where we have no droughts. But 49 did. So 49 gets in there, right? So the result for your taxpayer, your rancher, your farmer, is if your 4-year replacement period was set to expire at the end of 2025, you get an automatic extension. So, if your farmer is in one of those counties that's on the list, then you're able to you're not going to have to replace the livestock until the end of 26 at the earliest. So, you've got another year deferral, right? So that gives us a little more time. Will we have that? So the first tax year after a future drought-free year is declared for their region. And remember, you got to get through the entire, by this time, in theory, there are a number of counties you already can know have already blown it for 26 because they'll have a week in that 12-year period already. That was a drought week, severe drought period. So yeah, we're already there because we're now here, we're in September. So there've been a few weeks. So if you were basically still had a drought problem at the end of August, then it's like, like I said, if you have it at that week ending in August, at the very end of August, it's likely to have drifted over into September. So that's part of your deal. Next up, the IRS issued the special per diem rates. So this is notice 2025-54 for September 23rd, 2025. Now, this provides the special per diem rates, not the ones the GSA publishes that are very specific to each area, but these are the ones where you don't want to be looking those up for every place somebody goes. We just want to use the high-low method, so we have two different rates to make programming the computer simpler. So we can do that. And so these are the new rates that are going to be effective October 1st, Wednesday, right? They're coming up. Now, this notice works in conjunction with procedural rules established in Revenue Proc 2019-48. That's where you find out how to apply these. Now, the high-low substantiation rates for the continental United States is $319 to a designated high-cost locality and $225 to travel to any other basically locality in the continental United States. For meals and incidentals, if you are traveling to a high-cost locality, it'll be $86 per day. If you are traveling anywhere else, it'll be under Section 74. Now, these meals and incidentals are subject to the 50% limitation for business meals under 274N for travel business meals. So remember, you're going to effectively get half of those. But it does mean that you can reimburse your employee at 74 or $86 a day for meals without having to get the receipts. Remember, these are auto-documenting. As long as you can show that the employee was at that, was traveling, you're able to use these as auto-documenting ways of basically handling the per diem issues. Now, in the transportation industry, that special rate is $80, for any locality of travel within the continental United States, and $86 for travel outside the continental U.S. The incidental expenses only, if you're doing that is $5 per day regardless, right? That can be used by self-employed individuals that aren't incurring meal expenses, and that $5 is not subject to the 50% limitation. Now, to determine high-cost localities is based on the federal per diem rates. And a locality is designated high cost. The federal per diem rate is $272 per day or more. Now, this list is unchanged from the prior year. So usually there's at least one or two things that go on or come off. Now note, some of these locations are only on part of the year. There are seasonal times. So you got to kind of look and check, see what it is. Now, the special application of the rule we need to consider here. These rates are effectively, in place for per diem allowances paid for travel on or after October 1st of 2025. So this week, right, coming up right now. If you're listening to this on Monday or Tuesday, then yeah, you still can be under the old rule. But if you're on Wednesday, you're under the new rule. Now, remember, Revenue Proc 2019-48 has a special transition rule. If you wish for the last 3 months of this year, for October, November, December, you can go ahead and either pay the rates you used for the first 9 months or use the new rates. Now, you must make this choice consistently for all employees reimbursed under the high-low method. But what this does and why it was in there was to allow administrative flexibility. Now, if I recall correctly, a couple of years ago, the IRS tried to get rid of the high-low method, figuring, well, computers now, we're not in the 1960s or whatever, where we have, we were really, really concerned with really small, memory in the computer, and we weren't able to put large lookup tables in. So we had these just simple high-low locality tests, only had to do 2 different rates. Apparently, there are still people who don't want to change that and put the tables in, so we went back with it. Now, this notice supersedes Notice 2024-68, which set the rates for, beginning October 1st of 24. So that's basically where we're at. Next up, the thing I got the most questions about this week, basically the IRS put out news release 2025-94 on September 23rd that announced, beginning with individuals, the IRS will start eliminating the use of sending paper checks to pay tax refunds. And that'll begin on September 30 of 2025. There'll be no more individual checks. Now, as we talked about back in March, this was required by Executive Order 14247, signed by the President, that is titled Modernizing Payments to and from America's Bank Account. The justification in the executive order was that paper checks were 16 times more likely to be lost, stolen, or undeliverable than electronic payments, that it would save significant costs. Paper-based transactions cost the government over $657 million in the last fiscal year, and direct deposit is much faster, less than 21 days, than a mailed check that takes 6 weeks or more. The executive order also applies to payments made to the IRS, but that's not being changed right now. The IRS says continue to follow all current instructions. Don't worry about changing right now. We'll get there. Now, the refund methods they plan to use when they get rid of paper checks. First thing is direct deposit, already used for 93% of refunds. That is what the IRS is pushing strongly for taxpayers to provide the information to allow their refunds to be directly deposited into a bank account. However, they do recognize that some parties will not have bank accounts. So they are saying we may use prepaid debit cards, digital wallets that could receive the payment, and that limited exceptions will be available for taxpayers without access to banking services or in hardship situations where those other options don't work. Now, immediate action, there's no immediate changes made. Even if you put the notice out to clients, you have those clients that got the return back in May and they just never got around to signing the e-file forms, and you're on them right now saying, I need that form. You don't need to change what you told them, right? You can still process it as they were told, right? But you might suggest, taxpayers receive paper checks to secure their bank account routing numbers and get ready for them. And if you have any clients that don't have a bank account, which I think probably for most of us in tax practice, that's not going to be a problem. They do. But if they don't, you'd recommend resources like the FDIC's Get Banked initiative to find a way to get a bank account. And the IRS will publish detailed guidance for 2025 returns before the 2026 filing season begins. That's in line with what I expect. That they're not really going to worry about payments coming in by check until we get to actually filing the 25 returns. And so you may find there'll be no option to send a check in with your 25 individual return. You'll have to make an electronic payment, go online to the direct pay site, or give the IRS the account numbers to make that done. But I think that's the more likely way it'll go. In any event, be aware of it, and your clients, you may start. I'm a little concerned about getting a call from a client who gets one of the prepaid debit cards. Yeah, that's like, well, they said they wouldn't do it. I told you, that getting a refund by check might not happen. So, you got a prepaid debit card. That's how they're doing it now. But I don't want, it's like, fine, you don't want it. It doesn't matter. Okay. Next up, syndicated conservation easement case. This is a case of Jackson Stone South, and there's a related other plaintiff, Jackson Stone North. So we'll get into that. LLC versus Commissioners, Tax Memorandum Decision 2025-96. The case came down on September the 23rd. Now, this involved a syndicated conservation easement transactions where the partnerships claimed charitable deductions over $19 million each, based on a highest and best use of granite mining, something that was not going on the site. Now, this is something we have talked about multiple times in these conservation easement cases. This is not something the tax court's accepting. Just put it straight up. That doesn't mean a taxpayer might not win on this, but it does mean that win is almost certainly not coming in the tax court, right? So a family contributed land to the, Jackson Stone South and Jackson Stone North, I'll get my names out right there, partnerships. The promoter syndicated the deal. WS was the promoter, selling 95% of that LLC to investors and promising a 4.5 to 1 tax deduction. Yeah. Again, now, I think for most of us, that set off alarm bells instantly. How in the world, if you're going to put in $100,000 today, and you're buying a piece of land, and just the easement that you're granting on that piece of land, after it's gotten long-term treatment for you, and in this case, that was going to be easier for other reasons because it was long-term to the partnership, because again, the family contributed it. We're going to take $100,000, and supposedly your share of that land is going to be worth $450,000, just the easement portion. Why in the world, if that was true, wouldn't you just sell the land? Why in the world does it make sense the family would allow that to essentially be sold for $100,000 and then turn around, they're going to take only $100,000 from you, right? When it was going to go up and go through the roof in value in the very near future. That's the whole underlying problem with these things. So just stay there, right? 2 days after the investors bought in, the easement were donated. So in this case, we didn't even need to hold it for a year. It was 2 days. So let's see. So now I've got in my mind, I've got this piece of land. I'm just going to worry about my share because I paid in $100,000. My $100,000 piece of land is now worth more than $450,000. Why in the world wouldn't I just have them sell the land and give me the $450,000? There's no way the tax deduction gives me this sort of break. Tax deduction is not going to get me, $350,000. Because I put in 100, right? So I'll have to take that out because I'm not getting that, in essence, that goes away. So I put that in. Yeah, why in the world, wouldn't I just tell them to sell the land? But that's okay. Now, they use a discounted cash flow analysis based on a hypothetical granite mine that a buyer would say, hey, this is a perfect granite mine, and they would pay this higher price. Again, logic questions. Why in the world didn't they just sell? Why in the world didn't the family just sell it? I mean, it's tough coming up with a theory where economically they're better off not selling it at that super high value. Maybe the reason why they didn't is because, in reality, it was never going to be able to be sold in 2 days at that value. But in any event, we're back to this. So the IRS disallowed the deduction in full and they asserted the penalties. So obviously, this thing smells a bit, shall we say. That was what was going on. But let's take a look at it. Right. Now, the IRS they have a series of arguments, and the courts are rejecting a couple. Again, the courts rejected the IRS's donative intent attack. They're saying, hey, the only reason people did this was to get the tax deduction. They weren't really concerned about making a charitable contribution. And the court, I believe very properly, rejects that, saying, look, the investors objectively voted to donate, and the tax benefits provided by Congress, right? This is what Congress intended to do. If the family had just donated that land to charity, we wouldn't say that was, there's no donative intent, right? Even if Congress, let's say, makes it worthwhile to do it, and maybe even offer a better benefit, that doesn't change donative intent because Congress put that in the law. You can't say, oh, anybody who donates a conservation easement by definition doesn't have donative intent, because then it would be like the law would make no sense. So the court says, no, we're never going to consider that. The tax benefit by itself, we're not going to consider would negate donative intent. May have some other issues, but wouldn't negate donative intent. Now, the baseline documentation, okay, this is going to be on Jacksonstone North. The court disallowed that entire deduction based on this ground alone. They said the baseline report for this one was fatally flawed and inaccurate. It misidentified nearly half of the land cover. It said it was this very high value, rare type of forest and not kind of vanilla pine forest. They said those inaccuracies made it impossible for the donee to monitor compliance with the easement terms, violating the mandatory requirements of the regulation 1.170A-14G5. Because, the term said, there's all these special rules for this really protected type, unique environment, and really the land had almost none of it. So it was like that was bad. They also found that the JSN easement failed the conservation purpose test. The habitat, which involved that special type of forest, was insignificant. And the open space itself provided no significant public benefit. So it said, we're bad before we even get to what the court's going to really nail you on, right? The highest and best use, they totally rejected highest and best use of granite mining as how you should value this land. They said the highest and best use must be legally permissible and financially feasible. The court said the mining highest and best use failed both tests. It was neither legally permissible nor financially feasible. It's not legally permissible because the property was zoned agricultural and obtaining a rezoning was not reasonably probable. The county had not approved a new mine since 1996, and basically the neighbors were going to show up. Everybody around was going to show up and didn't want another granite mine. So it's one of those things where you just know you're not going to get it changed. There's a reason why we've been going for, in this case, what's essentially 29 years with no new mines being approved. It's like, nope, we're not going to get those. But even if they could get it rezoned, the local market for aggregate was oversupplied. The appraiser's analysis was based on flawed, unreasonable assumptions that it would make sense to open up this mine. It doesn't, right? It didn't have good access. There was all kinds of problems. You'd have picked any other property besides this one, is effectively what they're saying. So the court rejected that discounted cash flow analysis as inherently speculative and unreliable for vacant land. It adopted the sales comparison approach, which is not going to be good. Because guess what? 2 days before this was donated, we had effectively a sale, right? As it was donated, the money came in to buy the interest back from the family, and yeah, it just, we had a value. The claim deduction for each of these, Jackson Stone South and Jackson Stone North, was over $19 million. Right. The court's fair market value for Jackson Stone South was $460,000, and their fair market value for Jackson Stone North was $405,000. That is a more than 97% reduction in value for the claim deduction. You know we're going to have an overvaluation penalty now for sure. Yeah. The gross valuation misstatement penalty applied. The claim value was, the court noted, over 4,000% of the court's value found, which was way over the 200% threshold to trigger this penalty. It noted there is no reasonable cause defense available for the penalty on charitable contributions that relates to gross valuation misstatement. And because of that, you can't say I relied upon anybody for this, right? For Jackson North, the 20% penalty also applied to the portion underpayment related from complete disallowance. The baseline purpose phase. Remember, Jackson Stone North, they completely disallowed it because essentially, the baseline report and the purpose didn't make, neither of those worked because they so badly misidentified the type of forest. So because of that, there's an additional 20% penalty on the part that wasn't overvalued. So again, substantiation is not a mere formality, right? A flawed baseline report can be fatal. Any highest and best use must be realistic, defensible, and based on objective evidence, not just an expert speculative report. The court strongly prefers sales comparisons for valuing land. There better be a granite mine on there, or on the property next door, let's say. There's got to be an actual offer they turned down or something of that sort. I don't see any other way you're going to make that work. Just magically it turns up like this. And by the way, the reason why you won't find that is, of course, because had there been an actual offer out there, I'm pretty sure the family might have considered taking the cash. They got cash anyway, so, it was kind of, they get more cash. So if it sounds too good to be true, that's a major red flag. And that's why the courts don't have a lot of sympathy either. Now, this case, Harris did also try to say it wasn't qualified appraisal because they claimed essentially that there was effectively a deal. We've only seen that work once, where the appraiser effectively was found to have, in essence, effectively agreed on the value. The value was set by the promoter, and the appraiser just walked in and agreed to it. That was a case where there's a lot of documentation that made it pretty clear that was what happened. The court's not just going to say that, obviously they hired somebody who told them that they'd give this appraisal. And we could argue that probably the appraiser knew it needed to be really high to get this job. But the court's not going to go with just that. I mean, it's looking for a smoking gun in a case like that. The service has not been real successful there. Next up, let's talk about the case of a former state senator. In the case of Fumo versus Commissioner, Tax Court Random Decision 2025-97. This is on constructive receipts and excess benefits. Constructive receipt of income and excess benefits for a not-for-profit. So, we're now having the civil tax consequences following the criminal conviction of a former Pennsylvania state senator who was found guilty of defrauding the state Senate and a not-for-profit organization he controlled. Now, the scheme for the Senate that the court lines out here is that the claims were he engineered inflated salaries for staff who performed personal services for him. He used Senate staff to manage home renovations, run errands, and perform political work for him. And he hired ghost contractors, paid by the Senate, who worked exclusively for his personal political benefit, nothing for the state. So saying, hey, that's embezzlement from the state. For the 501c3, which was Citizens Alliance, there he used charity funds to buy personal items, tools, vehicles, farm equipment. And he paid for political polling in a campaign to oppose a project that would block the ocean view from his beach house out of this charity. None of which, the court would find was really part of its charitable intent. Again, He had already been convicted in state court, so we had a problem there, right? Now, the court relied on the broad definition of gross income, or 61, the doctrine of constructive receipt. A taxpayer's income when they are subject to their unfettered command, regardless of whether they personally receive cash. The power to direct funds is what matters. Did he have the ability to direct where the money went? Not necessarily if it went directly into his pockets. And for the excess benefit transaction, that occurs when a taxing organization provides an economic benefit to a disqualified person for more than the value of the consideration the charity received. And Mr. Fumo was a disqualified person because of his substantial influence. He basically ran the charity, right? Now, for his services to the charity to count as compensation, because you always go, wait, these excess benefits were really part of his compensation. The organization must show an intent to treat the benefits as compensation through contemporaneous written substantiation. A W-2, a 1099, a contract. If it was not in the W-2, not in the 1099, there's no contract saying it's that's part of his compensation, then the consideration is valued at 0. And the excess benefit is still going to be taxed back to him. Okay. Now, the income he constructively received, $1 million in excess staff salaries that he engineered, $1.4 million in the value of personal services from the staff, which is measured by his salary allocation, and $10 million paid to sham contractors. Now, the court rejected his theory that really none of that should count because he only received political capital, right? What he received was simply non-taxable political capital. So as such, hey, this doesn't count, right? It's not something that should really count for me is doing this, right? We have this particular issue. So essentially, hey, what we've got here. So the income and excise tax from the charity. The full value of goods and services was taxable income and was also an excess benefits under 4958. Because there was no contemporaneous documentation, the entire excess economic benefit, $483,890, was an excess benefit subject to the 25% first-year excise tax. Plus, good old, Mr. Fumo gets to pay tax on that $483,890, right? The excess benefit that went to him. That's, he's got to pay that tax, right? The court said a 75% civil fraud penalty, but he also picked up the income from the state. He had to pick that up too. That penalty, 75% fraud, so he pays tax on it, but does he owe the fraud penalty, which is 75% of the tax, which is nasty, right? Remember, he's still going to owe interest and everything, so this is going to be a really big bill, shall we say. And what we look at there, as the courts make clear, they're not ever going to find a case where, somebody just says, I plan to commit fraud, so please give this. No, you have to imply it based on what he did. And the courts look for what's called badges of fraud. And this is old common law structure to dupe fraud. In this case, they said some of the badges of fraud included that he consistently understated his income. So he left this stuff off of income, right? He engaged in illegal activities. He had convictions, as I recall. He essentially was convicted of 137 counts, including mail fraud, wire fraud, obstruction of justice, and aiding in the filing of false income tax returns. Yeah, so, illegal activities, right? And he concealed assets and income, covered them up, right? And he orchestrated a massive data wiping scheme per the court to obstruct the FBI's investigation into him. Court said, these all are evidence that this was based on a fraud, fraud. Big takeaway. Remember, he was trying to argue that none of this went to his personal bank account. He never got $1 from anybody. The court said constructive receipts means it doesn't matter if you can direct the funds. That's equivalent to receiving them and then paying these out to get these benefits, right? You could direct the funds or paying them out to go to somebody you wanted to favor, right? Whatever you're talking about here, so those are it. Also, for 4958, the substantiation rule is absolute. Any benefits provided to a disqualified person are fully taxable as an excess benefit without contemporaneous written proof they were intended as compensation. You got to put it in the W-2, in the 1099, or at least have it in the contract that this was compensation. None of that was the case in his case. And if you haven't noticed, we've gone through a few of these cases too. Once you have a criminal tax-related conviction, the odds are overwhelming you're going to lose on the civil tax penalties, right? They kind of defer and delay those till after the criminal case, so that you can, quote, concentrate on your criminal case, but it gives them an advantage too, because essentially it's game over. Everything you're convicted of is deemed to be proven. And that makes it really tough to get around the badges of fraud. Next up, a whistleblower award. The DC Circuit reversed the tax court. This was, and I love the name of the case, but at the circuit court, at the DC Circuit, in re-sealed case. Well, it's whistleblower case at the tax court, so not much better. But it is from the Court of Appeals for the District of Columbia. This is case number 24-1001. The opinion came down on the 24th of September. Now, the issue is whether the IRS Whistleblower Office, the WBO, abused its discretion by awarding a whistleblower a lower percentage, 22%, for a claim involving one company when it awarded the maximum 30% award of what was collected for claims against 4 other firms involved in the exact same avoidance scheme. Now, the WBO justified it by claiming the IRS audit team for this company, this one company that he got the lower award for, was already pursuing the dividend withholding tax issues, which is what this was about, before receiving the whistleblower's information that justified a lower award. And the tax court sided with the IRS. It held that the WBO has broad discretion, is not required to be consistent between claims, and its decision was supported by the administrative record. The Court of Appeals is going to disagree with basically all of that. We'll get in there. The D.C. court vacated the tax court's decision, finding the WBO's determination was failed even under the deferential abuse of discretion standard. The WBO's key factual finding, the audit team independently discovered the complex scheme, was clearly erroneous and not supported by the records. The Court of Appeals said, look, this guy had essentially, brought this whole thing. It was an industry-wide issue. He worked for one of the companies, but he knew it was taking place in the others. He brought it. The IRS admitted multiple times. It was a Senate hearing where he exposed this right in front of the Senate. Right? He did that. The IRS was aware. And the IRS admitted in the other cases they had never uncovered or understood this. They would have ever understood what was going on without his information. And the court said, somehow, though, you're telling me the audit team would have figured this out, right? The appellate court found WBO improperly conflated the start of an audit with the identification of the specific novel tax evasion scheme. What the court said is, yes, you had started examining, you had an exam going on this company, right? But that's not the key issue here. It's not whether this guy's, whistleblower initiated the exam. The question was, did it initiate this issue that you've now decided to raise in this exam, right? The audit team's statement that the whistleblower did not initiate the exam did not prove they independently uncovered the complex tax transactions at issue, basically without assistance from this guy. And the court found it implausible that the IRS would have uncovered it at this other organization had this guy not come forward. Right? It said it was highly improbable that one audit team figured out the scheme on its own when the WBO admitted in other awards that the IRS's understanding came entirely from the whistleblower. In essence, there's no justification for why it would be lower in this case. Now, this means there was a different level of scrutiny. The tax court took a highly differential approach. So it would accept the WBO's conclusions at face value, while the DC Circuit dove more deeply into why. Certainly, I expect, especially for any cases going back to DC Circuit, that the tax court's going to be aware that inconsistencies in the WBO's actions with regard to a whistleblower probably aren't going to fly, right? So the discretion was held not to be unlimited. Its decision must be grounded in a factual record that can withstand judicial scrutiny. And an award determination that treats similar claims from the same whistleblower inconsistently has to be supported by a clear, unambiguous, and factually sound explanation, which the court found was not provided here in the administrative record. So again, this is just inconsistency was a big problem. Next up, our fun case here, and the final case for this week, employee versus independent contractor. This is a case of Francisco Gil et al. Versus United States. United States District Court for the Eastern District of Pennsylvania. Case number 24825, September 25th, 2025 is when the opinion was released. Now, this question whether a longtime financial advisor at Wells Fargo and through the various forms that Wells Fargo advisors had over the years was a common law employee or independent contractor determining his ability to deduct business expenses on Schedule C. This is being driven to a large extent by TCJA, Tax Cuts and Jobs Act, and the fact that employee business expenses are no longer deductible, which, again, the OBBBA, OB3, has made permanent. Now, he claimed he was an independent contractor or a statutory employee who was entitled to use Schedule C based on the fact he was paid on commissions only, that he could set his own hours, and that he had responsibility for paying certain expenses. Right? The IRS said he's a common law employee. Schedule C deductions are improper. Right? Now, remember, over the years, Wells Fargo consistently classified him as an exempt employee, issued a Form W-2 and withheld taxes. Now, an exempt employee means somebody who's not covered by the Fair Labor Standards Act or even the minimum wage issues, right? He always got a W-2, he had taxes withheld, and he participated in employee benefits, which is all part of this issue, right? Now, it's still possible that somebody could be on the payroll, but not really be an employee. And there is an 8-factor common law test, right? The degree of control, the court said, is the crucial consideration. If the person paying you exercises too much control, that's going to make it very difficult, even if the other factors go in your favor. In this case, Wells Fargo supervised his work as a manager. They set his goals and they required reports from him, right, to come in. In addition to that, though, they have 6 other of the 8 tests they're going to carry. Wells Fargo provided the investment in facilities. They provided his office, his computer, and all of his support staff. Wells Fargo had the right to terminate the contract at will, right? At will employee. His work was an integral part of Wells Fargo's business, right? He was an advisor. He was at the core of their business. It was a permanent relationship. It had been 35 years with Wells Fargo or a predecessor, right? And like I said, I think he started with Prudential. And then the case kind of follows through all the various names that they kept changing over the years, right? So he was there for 35 years. The parties believe they created an employment relationship. W-2s were issued every year and withholding came out of his check, right? Which he never really protested that. Wells Fargo issued it that way. It kind of indicated Wells thought he was an employee. And he really didn't complain about that right away, right? And Wells also offered him health insurance and a 401k, which he participated in. The only thing that didn't say contractor status was the fact that he had an opportunity for either profit or loss, that he had a commissions-based pay rather than hourly-based. But the court's going to find that's just not enough. 78 factors point to employment relationship. He was a common law employee. Therefore, he could not use Schedule C and he could not deduct expenses above the line or, frankly, anywhere because he was a common law employee. The statutory employee argument, I tried that one. He was trying to argue, well, one of the things which he could sell for Wells Fargo was life insurance, right? So he claimed, well, one of the statutory employees, and one of those things that allowed to be treated, that you put on a W-2, but they're not really an employee, so they get the Schedule C deductions. Yeah, weird category, very limited number of things that fall in there. But the court dismissed that claim as a full-time life insurance salesman because that was a very, very small part of what he sold. He wasn't down there full-time selling life insurance for Wells Fargo. He could sell it, but that wasn't really the whole gig. That was anything close to the whole gig, right? And they also cannot be a statutory employee if they're already a common law employee. So you could be a common law employee. Remember, a statutory employee is somebody who should be a contractor. We're going to treat him as a W-2 employee for, as I recall, the rule goes down to for purposes of FICA coverage. And his principal activity was not selling insurance for a single company. He was a comprehensive financial advisor. So the common law employee, the mere fact that he could sell life insurance, and he did every so often, didn't change the other two facts. He was already a common law employee, and he wasn't a full-time life insurance salesman. He did all those other things. So this is basically the common law test. The employee's right to control, the employer's factor right to control combines like factors of providing benefits. Permanency will tend to outweigh commission pay or the fact that somebody has to work out of their own home office. They could have required that of him. It probably still doesn't cover this, how it would work. Now, again, this has become a much bigger problem ever since we lost all employee business expenses. It was a problem anyway before because of the AMT, but I suspect that this particular taxpayer had enough ordinary income that the AMT problem wasn't as huge as 2% of AGI might have been, but the AMT wasn't. But now with total disallowance, it's a much bigger problem. You just can't do it. And that's part of it. What are the solutions for the employee? If the employer will consider it, which I'm almost certain they won't, but if they would, it's much better to agree to an accountable plan where you're going to be reimbursed and maybe take a lower commission rate, but in exchange for that, accept basically an accountable reimbursement program where those expenses that right now you're required to incur, that Wells Fargo agrees to cover them. That said, I think it's going to be very difficult to get a large employer to do that unless you have basically every financial advisor for Wells Fargo is threatening to walk out unless this is changed and take their customers with them. So, yeah, it's not likely you're going to get that done, but that's part of how it works. This has been the current tax developments for September the 29th. As always, you can email me at edzollers@currentprotectdevelopments.com. And if I have time, again, this is a weird part, right? Next 2 weeks get really weird because we're heading to the October 15th deadline and all those end of tax season people you have to deal with. So I'll have that going on, but it's there. I also am, as always, on the Connect sites for the Arizona Society, New Jersey, Idaho, Minnesota, Illinois, and also Washington. So if you have questions, you can post to their sites. I may see your questions and might be able to give an answer back. We'll see what's there. Otherwise, though, hopefully we'll be back next week. I don't know what's really going to happen next week, especially if the government does shut down, what parts of the IRS will shut down and what'll end up happening. How the courts and everything, if everything gets published right, if we really get guidance or what we're doing. So we'll just have to take a look and see how that goes. But we'll be there. And again, due to the fact it is end of tax season, it is conceivable that I might decide I have to actually do some tax work, at that time, depending on how everything lines up. So we may have some delays here, so I'll warn you right now. But otherwise, I hope to see you next week, and we'll talk about more current federal tax developments.